Hey everybody, it's Mike from Orderflows, and in today's video, I'm going to talk about stopping volume. I did a presentation the other day. It's up there on YouTube. It's called Discover New Trading Strategies with Orderflow, and one of the things that I talked about in it was stopping volume. And what stopping volume is basically volume that appears in the order flow that essentially stops moves. Now, it doesn't mean it stops it for the rest of the day or the rest of the week. It stops it right now and often causes a reversal. And one of the easiest ways to see it is by looking at points of control. Now, nowadays, in the year 2022 that we're in, the markets are much more volatile than they were, 10 years ago, 5 years ago. And honestly, you used to be able to see it a lot more in the past because markets just didn't have this volatility that we're seeing nowadays. And one of the easiest ways to see stopping volumes is what I call point of control on the extreme. And in the bonds, you still tend to see it in more of the the more, what do you want to call it, the interest rate markets and commodity markets. So this is the ZB, the 30-year bond. Point of control on the extreme, very visual, very easy to see as a trader, right? It's simply a red bar with the point of control at the very top, or a green bar with the point of control at the very bottom. Now, when I say stopping volume being a reversal, right? If you have point of control at the top of a green bar, that's not reversing anything, right? The market is still moving higher. But when you have the red bar with point of control at the top, obviously the price action is starting to go down. So here we have, the market rallied from, 14 all the way up to 01, hit some volume up here at 01, and in the bar, the market turned around and started selling off and sold off over the next two bars, a good 8-9 ticks. Right, then we went back up. We sort of hit that level, rotated around for a couple bars, poked up a little bit higher. And it's more or less, just rotating around that level at 00 and 01. And then at 00, we put in some, finally, the buyer stepped in and put in a base here, right? They said, okay, we're going to support it here at 01. You got the point of control on the bottom, and the market kept rallying, right? So how do you trade this? Well, when you see it, right, wait for the bar to close, because obviously, if you see it early in a bar and you get all excited, traders love to get excited, and that's one of the problems that many traders have, is they get excited too fast. And ultimately what they end up doing is getting into a trade early that they really should just stay out of. So wait for the bar to close at a bare minimum, and let it print. Let that bar finish. And once it does, watch the next bar. Is it continuing in that direction? If it is, then you get short, right? If it's a short signal, or you get long if it's a long signal, because time and time again, order flow changes in a bar. I mean, even on a 1 minute, this is a 4-range bar, but even on a 1 minute bar, there's times where in the first 5-10 seconds, very bullish, and people think, oh, I got to get in. I'll get in early, make a few extra pips, and then ultimately things change in the bar, and what was looking bullish turns out to be bearish, and the market's reversing, and all of a sudden you're stuck, holding the bag, so to speak. Now, when I talk about stopping volume, it doesn't necessarily have to be points of control on the extreme. Nowadays in the S&Ps, it's very rare that you see one, and what I like to look for is them appearing, sort of, near swing highs or swing lows, points of control somewhere up near the top for, reversals for shorts, or somewhere near the bottom for bullish ones. And, on the Orderflows Trader software, we actually have this thing that's called the prominent point of controls, right? Which are point of controls that matter, right? Remember, every bar has a point of control, right? So you see point of control 1, 2, 3, prominent point of control, level 1, level 2, level 3. For now, I just got level 1 turned on in level 2. And I love finding them, coming in at swing highs and swing lows, because they're potential market turning points. Okay, so here's a swing low, right? I got a bullish prominent point of control. Market just went sideways a little bit. I mean, it did pull back a little bit further. Then you got a nice little rally there. All right, here's a nice bearish one. And the reason I'm looking at the top 2 point of controls as opposed to a point of control on the extreme is because due to the volatility now that exists in the market, it's you're getting the wider bars, and you're just not going to get them. On a bar that trades 10, 15 ticks, it's very rare that you're going to get the point of control on the extreme, just because there's so much other activity going on. Price discovery, algos in the E-minis, in these equity markets, they're really, will uptick it, that it won't necessarily appear right up there. And like I said, wait for the bar to close and wait for the next bar to confirm. So for example, this is a prominent point of control because at this time, right, the market was going up, right? If you're looking at it like right here and thinking, oh, I got a bearish prominent point of control here, I got some stopping volume, I got these 2 point of controls lined up, that's potentially bearish in the sense that this bar is a red bar. Now, however, you got to still analyze what's happening in the market, right? Yeah, it's a red bar, but barely, right? The market actually traded down and closed, within a tick of its high. You got these 2 point of controls lined up side by side here, which, is important because you got 2 here, you got 2 here, now you got another 2 here. So, they're sort of migrating higher. This one isn't one, it's confusing. You got to wait for the bar to close and then wait for the next bar to form. Okay, if it starts trading lower, yeah, potentially, that's my opportunity to get short. But in the next bar, the very next bar, what happens? It doesn't go any lower. It holds the low of this bar and actually trades higher, actually trades above the high. So this bearish point of control is no longer bearish, right? The whole reason for it being bearish is gone already, right? Because we traded up through it. It's violated. Then the market goes a little bit higher, comes in, goes sideways, goes back up. Now you got another bearish prominent point of control. You got some stopping volume appearing up here. Now, if you were to, just go back here, right? You got this one coming up. Okay, point of control is not lined up like they were earlier. It's a little bit higher, which is nice. This bar, it's, the point of control is on this bar is coming in higher than any of the previous bars, which is also nice to see because, it's just sort of poking up. It's just sort of like the market is coming up, sticking its head up out of its hole, taking a look around. I want to go higher. Traders are trading back and forth. There's some volume coming in. That's the heaviest volume in the bar. And we're going to see what happens. Well, the market reverses down. It closes down near our low. Okay, so it's bearish, right? This bar is looking much more bearish than this bar earlier, right? This bar, we closed just right up here near our high, even though it's a red candle. Now here we got a red candle, but the difference, we're closing near our low of the bar. Obviously, we got that big wick up here. So what do you think is more bearish? This bar here or this bar? Well, obviously this bar, right? Because the price action is telling you that selling is coming in late in the bar. That's why I always say, wait for the bars to close. Because, while this bar early may have, big red bar down here looking bearish. Oh, I got to get in now. Well, if you got it now, by the time the bar closed, you're like, this doesn't look as good as it did before. Whereas this bar here, early in the bar, it's green. It's a green candle. It's trading higher. But it reversed and started trading down. And it closed down. It looks bearish, right? So, okay, maybe you're still confused. Wait for the next bar. Take it on a bar-by-bar basis. Next bar, obviously, big bar down. Now, do you have to wait for this bar to close to be confirmed that, yeah, this market's going down? Yeah, you can, but you don't need to. I like to just let the market start ticking down, taking out the low of the bar that I think is a bearish bar, just to confirm that, yeah, price is moving. That's where I'd be looking to get short. Where do you place your stop? Just right above the high of this bar, because the point of control is up near the top. And if I'm thinking of stopping volume, if the market's going to get past any heavy volume up here, I don't want to be short anymore because it's gotten through that volume. Just like here, if I was short off of this bar, say, you know what, I got to get short because, it looks bearish, and I just get short, pull the trigger immediately. Okay, where's my stop? It's just right up here, right above the high of the bar. The high of the bar with the bearish point of control, what I consider stopping volumes. Because if it trades back up above 64.5 here, then my whole idea of being short is violated, right? I don't want to be short anymore. So that's the differences between this one and this one, right? It's, again, sometimes traders like to make things more difficult. let the market show you let it tip its hand, let it show you the direction it wants to trade in. And as soon as it does, that's the time you pull the trigger. You don't need to wait for this bar to close. A lot of traders, that trade with, other forms of analysis, technical analysis, head and shoulders, etc. They're always waiting for confirmation. That's fine, but you're also giving up tips. As long as the market just starts showing its hand, it's sort of leaning in a direction, it's giving you all the signs that, yeah, this is the direction we're going in, that's when you want to take advantage of it. Okay? So, hopefully you understand what stopping volume is a bit better, and how to take advantage of it. Another way I like to use it really quick is I like to use it as levels where the market could come back. Okay, so, this is a point of control at the extreme. It's not a prominent point of control, but nevertheless, it's just a normal point of control, but it's appearing at the bottom of a green bar. So I know that there's some volume down here, heavy volume. Okay, I like to just trade these for, markets, if they come back, that's a potential a place to buy it, right? Imagine it came right back to 67 and then just shot straight up. It's like those carnival games, where you got to hit the lever and it shoots the thing up. That's what it looks like. It just came right down to that price, got through it by one tick, and then shot up from 67 all the way up to, what is that, 73 3/4 in the same bar. Now, they don't always, look as nice and neat as that, but, you don't need to be right every single time, right? You're just risking 2 or 3 ticks to, take advantage of it. Let's just see if there's anything else here. This was today. Not really. Here's 2 bearish prominent point of control, some stopping volume coming in these 2 bars. And you can just see how the market reacted nicely right off of that. Just sold off very quick from 87.5 all the way down to where is it? This is like 81. But call it 82 because this is 82 right here, from 87 down to 82. Quick 5 points in 5 minutes. So anyway, guys, I'll end it there for today. Hopefully you got your creative juices flowing on what to look for with point of controls. So thanks, everyone. Be sure to like and subscribe to the channel, and be ready for the next video. Bye-bye.